everybody, what's up? It's Friday, October 22nd. Yeah. So, what's going on? Earlier today, I made that little quick short video about my impressions from my appearance yesterday on RT, and I commented on the comments made by my co-panelist, I guess you would say, the other guest who was on the show, because when I mentioned that during the pandemic, personal savings shot up to historic levels as a result, and I said it was as a result of the fiscal stimulus, you know, the unemployment, the supplementary unemployment, the checks that were sent out, other means of fiscal support. He came back and he said, you know, that he agreed with me, but he said that it was because everybody got really worried about, you know, the durability of their income, and they saw that a crisis could hit or something like the pandemic could hit, and suddenly, you know, their source of income is very tenuous, so everybody just held on to their money. But that's not how it works. Now, this guy, I'm not here to knock him necessarily, but he's a PhD economist, and it shows you, you know, what they teach as far as economics in the mainstream academia, and how wrong it is. But it just should be sheer logic that, you know, if we all save, if we all hold on to our money and nobody spends, then the savings rate cannot go up. Again, my lack of spending, my you know, saving equates to somebody else's loss of income and savings. And I've used the same example over and over. Like, if I don't, and I use it because this was an example put out by Neil Kashkari, who is the president of the Minneapolis Fed, because he said, well, I'm not worried about the economy because we have such a high savings rate because we didn't go to restaurants and movie theaters. But again, if I don't go to a restaurant or a movie theater, then the income of the restaurant owner and the movie theater owner goes down, and their savings go down. So you can't grow savings that way. Anyway, I just wanted to repeat that because, yeah, and I didn't have time to respond, and the guy seemed like a nice guy, so, I mean, whatever. All right, the market, we had a mixed close today. Dow was up, NASDAQ was down, S&P was just slightly off its record high. Look, something that I've been telling you recently appears to be happening. We had a very large increase in bank loans in the week ending October 13th. Loans and leases were up 37 billion. That was the biggest 1 week increase in 18 months. And that happened during a week when we actually saw a modest increase in bank reserves. So normally when you see an increase in bank reserves, you would think that there would be not much of an increase in loans. Again, understand that reserves are bank assets. When they come piling onto bank balance sheets, it tends to inhibit other asset accumulation, of which that could be loans. Now, you know, so I've been telling you that I think what's going to happen now going forward, especially since they raised the debt ceiling, and we're going to start to see this reserve drain. As a matter of fact, we did in the latest week, we saw a 150 billion reserve drain, and that was the biggest 1 week reserve drain in 4 months. So I think we're going to see a very substantial increase in bank credit and bank loans. And again, there's two kinds of money, all right? One is the government kind. That's the best kind because that comes to us without any offsetting liability. You know, you get a Social Security check, or if you're a vendor to the government, you get a payment or whatever. Unemployment benefits, that's your money to keep. Bank credit yes, you get a deposit in your checking account, but at the same time you have a liability, which is that loan, and you have to pay it back with interest. It's not necessarily something right now that we have to worry about because debt service burdens are at an all-time record low. I said that as well on the RT show yesterday. So I think what we're looking at is a fairly decent level of fiscal flows. It's going to come in this month at around 490 billion. Not too bad. Okay, I was worried that it might go under 400 billion, but it doesn't look that way. And now we are seeing a very appreciable increase, what I think is going to end up to be a very substantial increase in bank credit and bank loans. By the way, real estate loans jumped a lot too. Residential real estate loans, I think, up almost like 20 billion, 18 billion. That is a big, big increase. But let me just say that before the pandemic hit, loan growth was about 5% year over year. So the loans were growing at about 5%. Then it went way down negative, and it stayed negative for a long time. In other words, loans were contracting. But now it's back in positive growth. It's at 0.7%, which doesn't sound like a lot, but it's like only the second week now that we're in positive loan growth. And I believe it's going to get back to that 5%. So we got a good period ahead of us, probably 6 months, 4 to 6 months of very decent loan growth. And also, by the same token, that's good for the banks and good for bank stocks because, you know, that's how banks make most of their money. Not most, but I mean, that's an important source of income for the banks is lending, loans. That's their primary activity, right? So it's looking good. It's looking good. The only thing I would say, two things. Number one, the Fed is going to embark on taper. You know, that's cutting its asset purchases in November. So we could get some volatility, and the zombies are going to freak out and they might sell the market, but I would buy into that. The other thing is going to be the debt ceiling once again at the end of November, because December 3rd, the current situation kind of runs out. So we're going to be in that same problem again. Hopefully we get all through this. And then I'm saying 4 to 6 months of very good loan growth and fiscal, and that should be really bullish. We'll finally see Dow 36,000. We're knocking on the door right now. It's not that far. So looking good. But I'll keep you informed. Don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. Bye-bye.